Welcome, curious minds, to another deep dive. Today, you've brought us, well, quite a stack of critical sources, and we're plunging right into the Q2 2025 earnings analysis for Nebius Group N.V. That's ticker NBIS. We're definitely not just skimming headlines here. Our sources provide this really smart, structured framework, integrating company data with real-time market insights. It's all to give you a kind of backstage pass to what these numbers really mean for Nebius and the broader AI infrastructure market.
That's exactly right. Our mission here in this deep dive is really to move beyond just the surface noise. We want to help you uncover those truly important nuggets, the key insights, so you understand not just what happened, but the why behind Nebius's performance. It's about seeing both let's say, the strategic forest and those crucial financial trees.
Okay, makes sense. Let's unpack this then. We'll navigate through the analysis section by section, just as it's laid out in your source material. Let's kick things off with what our sources are calling Slide 1, the at-a-glance scorecard.
Okay.
So this is that immediate snapshot, right? The top-line summary of Nebius's Q2, set against Wall Street expectations and the market's first reaction. My first thought seeing this was just, wow, that's explosive top-line growth.
Yeah.
But then the source calls the market's response measured. What did the numbers actually show, and why that seemingly quiet reaction?
Yeah, that's where it gets pretty interesting. Nebius definitely delivered an impressive revenue beat, no question. They reported total revenues of $105.1 million. That easily beat the Wall Street consensus estimate, which was around $95 million, so that's about $10.1 million higher, or 10.6% above what the street expected. Solid beat.
Okay.
However, the press release didn't actually give an EPS figure, an earnings per share number, so you couldn't do a direct comparison on that front.
Got it. So a clear revenue beat, over 10% above estimates. That sounds fantastic on the surface. Yet the market's initial reaction, as you said, was just a modest gain. Was it under 3% in pre-market trading? Why so cautious?
Precisely. That modest gain, even with significant revenue beat and raised guidance, which we'll get to, it tells us investors are looking deeper. They're weighing that impressive growth against some, well, pretty substantial realities. The source points out that the initial analyst sentiment was, frankly, mixed.
Mixed? How so?
Well, they applauded the growth, naturally, but there were clear concerns being voiced about the significant cash burn, the ongoing operational losses, and, of course, the intense competition in the AI infrastructure space. It's not just enough to grow fast. You need to show a path to making it sustainable.
Right, sustainability. Still, it's hard to just ignore that staggering 625% year-over-year revenue growth figure. I mean, they went from $14.5 million in Q2 of last year to $105.1 million this Q2. That's monumental growth.
It absolutely is. Monumental is the right word. And on the surface, the net income swing looks just as dramatic. They went from a loss of about $117 million in Q2 2024 to a profit of $502.5 million in Q2 2025.
Wow.
But, and this is a big but, this really requires a deeper analysis, as the source highlights very clearly. This profit wasn't driven by their core business operations. It wasn't from selling cloud services. As the CEO, Arkady Veloz, himself noted, demand for AI infrastructure, compute, software, and services is only going to get stronger as use cases multiply. So the demand is real, the growth is clearly there, but how that profit number came about is absolutely critical to understand.
Okay, so from that top-line view, let's now dive into what our sources label Slide 2, the engine of profitability.
Yeah.
This is where we look past those headlines, I guess, to find that crucial distinction between the reported GAAP net income and the true performance of the core business.
Exactly. And this is where it gets a bit like, financial detective work. While Nebius reported that eye-popping $502.5 million in net income, their loss from operations was actually a negative $111.2 million.
Oh, okay. Big difference.
Huge difference. The loss from operations tells you about their core business performance, the actual profit or loss from, selling their AI platform services. So where did that reported net profit come from? It was entirely due to one single non-operational, non-cash event.
Oh, my gosh.
Right. A $597.4 million gain from revaluation of investment in equity securities. Basically, the value of some investment they hold went up on paper. This wasn't cash coming in from customers. It was a pure paper gain. And that's what the source calls the illusion of GAAP profitability. It's absolutely critical for investors to spot that distinction.
Fascinating. Okay, so the GAAP profit isn't really from the business itself. What about the non-GAAP metrics then? Do they tell us anything more about operational progress? I see here the company's adjusted EBITDA showed a loss of Medica $21.0 million. Now, that's still a loss, obviously, but it is a big improvement, right? A 64% improvement from the negative $58.1 million loss in Q2 last year. That does seem to back up the CEO's statement that the core business achieved positive adjusted EBITDA ahead of plan.
That's exactly right. And this is where the power of operating leverage really starts to shine through.
Operating leverage. Can you break that down quickly?
Sure. Operating leverage is basically that sweet spot where a company's profits can grow faster than its revenue. Usually because its fixed costs, think data centers, core R&D teams are spread across a much larger sales base as revenue grows. So once that data center is built, for example, each new customer or each new unit of compute sold helps spread those massive fixed costs thinner, directly boosting profitability or at least reducing the loss margin.
Okay.
And Nebius's numbers demonstrate this perfectly. Revenue grew by that astounding 625% year over year, yet its operating loss remained almost flat, around $111 million in both quarters. What that means is their operating margin improved dramatically. It went from a truly awful negative 773% to negative 105%. Still negative, but a massive improvement in efficiency.
Right, you can really see the leverage effect there. And the source of this leverage becomes even clearer when you look at how different expense lines performed as a percentage of revenue. Cost of revenues, for instance, fell from 53% of revenue down to just 29%. That's huge.
It is.
And product development, which was an enormous 221% of revenue in Q2 2024, dropped way down to 41%. And sales, general and administrative costs. Wow, they were 521% of revenue last year, now down to 65%. That's just a massive gain in efficiency across the board.
It's a very, very strong positive indicator. This trend suggests that as Nebius continues to scale its revenue, which they clearly are, it has a clear path forward. It's still a distant path, mind you, but it's a clear path toward achieving genuine operating profitability. They are getting significantly more efficient with every dollar of revenue they bring in.
Okay, that makes sense. Moving on then, let's explore slide 4, financial strength and shareholder rewards.
Wow.
This section, it sets the stage for analyzing Nebius's balance sheet and cash flow. Helps us understand exactly how they're funding this incredibly aggressive growth strategy. What we're seeing here really looks like a profound strategic transformation in action.
It absolutely does. The balance sheet changes just looking from the end of last year, December 31st, 2024, to June 30th, 2025. They tell a very clear story. Cash and cash equivalents, down by over $750 million.
Wow.
But simultaneously, net property and equipment, which is mostly their data center hardware, the servers, the GPUs, more than doubled. It increased by nearly $1 billion, $942.7 million. This lines up perfectly with the CEO's stated plan to aggressively scale up capacity. They are clearly pouring capital into physical assets, putting their money where their mouth is.
So if they're investing that heavily, what does their cash flow statement tell us about how they're actually funding it? Are they burning through a lot of cash to fuel this ambition?
Oh, yes, they definitely are. Yeah. The cash flow statement confirms that narrative completely. In Q2 alone, Nebius spent an astounding $510.6 million just on purchases of property, plant, and equipment. That CapEx figure is up 221% year over year.
221%.
Yep. And cash used in operating activities, so the cash outflow from just running the day-to-day business, that increased to negative $167.7 million for the quarter. This is the classic hypergrowth playbook you see, especially in capital-intensive industries. Deploy massive amounts of capital to build out revenue-generating assets, capture market share fast, even if it means significant negative cash flow in the near term.
Right, the land grab phase. And how did Nebius actually fund this massive investment then? Did they take on a lot of debt, for instance?
They did. To fuel this ambitious expansion, Nebius significantly changed its capital structure. They took on nearly $980 million in new non-current debt, long-term debt.
Almost $1 billion in due debt. It sounds like a lot.
It is a big number, absolutely. But what's crucial to note here, according to the source analysis, is that despite this substantial borrowing, the company's financial leverage actually remains pretty conservative. Their debt-to-equity ratio is still quite low, calculated at 0.26. That suggests they still have a strong balance sheet, relatively speaking, and likely still have significant capacity for further borrowing if they need or want to fund even more ambitious growth plans down the line.
Okay, interesting. And consistent with this intense focus on reinvestment, I see Nebius did not declare any dividends or announce any share buyback programs during the quarter.
No, and that's entirely expected. It's a deliberate and, frankly, the appropriate strategic choice for a high-growth company at this stage. Returning capital to shareholders through dividends or buybacks right now would be counterproductive. Every available dollar is clearly being prioritized for reinvestment directly back into the business. They're laser-focused on solidifying their position in this rapidly expanding AI infrastructure market, and that requires every bit of capital they can possibly muster.
Makes total sense. Finally then, let's look at slide 5. The road ahead management's outlook and key takeaways. This section introduces management's commentary, which sounds exceptionally bullish, reflecting, I guess, that powerful momentum and some very clear strategic priorities.
Yeah, management's outlook is incredibly telling. Let's break it down based on the source. First, on growth and guidance. They're not just confirming expectations, they are increasing their annualized run rate revenue, ARR outlook for the year, to $900 million to $1.1 billion.
Three, just to clarify for listeners.
Right. ARR is basically a projection of their full year revenue based on their current quarterly performance. So taking Q2's revenue and annualizing it, plus future expectations, raising that range significantly signals very high confidence and continued strong growth. Second, on scaling infrastructure. They state, we are aggressively scaling up capacity to capture this substantial opportunity and are in the process of securing more than 1 gigaW of power by the end of 2026. That 1 gigawatt figure really quantifies the sheer ambition. Building out AI data centers at that scale requires massive, massive capital investment.
1 gigawatt, that's a lot of power.
It really is. And third, on the path to profitability, they reiterate that in Q2, we more than doubled revenue from the previous quarter, and our core business achieved positive adjusted EBITDA ahead of plan. Hitting positive adjusted EBITDA, even if it's non-GAAP, is a key milestone they wanted to highlight, showing progress towards more sustainable performance eventually.
Okay, so putting it all together, what does this all mean for you, the listener? The key takeaways from this entire analysis seem to boil down to 3 main things. First, we've clearly seen explosive growth, and it's now validated by that raised guidance. That exceptional 625% year-over-year revenue growth beating expectations, it's now backed up by management raising the full-year ARR outlook substantially. This suggests the intense demand for AI infrastructure isn't just, a blip. It seems sustainable, maybe even accelerating.
Second takeaway, and we really can't stress this enough, the profitability you see on that main GAAP income line, it's largely an illusion for Q2,
Right.
but the operating leverage, that is absolutely real. Remember, the headline GAAP profit of over $500 million came entirely from that one-time non-cash gain on an investment. The actual core business lost money at the operating level.
Right.
However, that dramatic improvement we saw in the operating margin demonstrates powerful operating leverage is definitely at work. It shows the business model is scaling effectively, and it suggests there's a clear, even if still distant path to achieving genuine, sustainable profitability from their main operations as revenue continues to climb.
And third, it's crystal clear Nebius is all in on growth. This is definitely a high-risk, high-reward capital strategy they're pursuing. The company's burning through cash, negative $167.7 million from operations in Q2 alone, and taking on almost $1 billion in new debt, all to fund that massive increase in data center assets. This growth at all costs approach, or maybe growth first, is a high-stakes bet on capturing a dominant share of the AI market. And that's likely why the market is reacting with cautious optimism, despite that spectacular revenue beat. They see the potential, but also the significant risks and costs involved.
Yeah, if we just zoom out for a final narrative here, Q2 2025 really marks a pivotal moment for Nebius. No doubt about it. The company has emphatically answered that first critical question for any hypergrowth contender, which is basically, can you capture the market? With the 625% surge in revenue and that major guidance increase, the answer seems to be a resounding yes. Nebius has absolutely proven its ability to translate this immense market demand for AI infrastructure into staggering top-line growth. Exactly. But these results immediately shift the focus to the next and arguably more difficult set of questions. Okay, at what cost can this growth be sustained, and when, if ever, will it become truly profitable on a GAAP basis, and more importantly, generate free cash flow? The quarter's financials reveal the high price of this ambition. The core business, let's remember, remains unprofitable at the operating level. It's burning significant cash to fund those massive capital expenditures. And that headline profit, as we've discussed extensively, wasn't a sign of operational maturity at all, but rather just an accounting gain on an investment. So this is the story of a company successfully but very expensively executing a high-risk, high-reward strategy. For investors, for you listening, the narrative is no longer solely about the sheer potential for growth. It's now much more about the long and very capital-intensive road ahead to convert that impressive growth into sustainable, profitable cash flow. And this deep dive into Nebius's quarter really highlights the power of using a consistent framework like the one in our sources. It helps you cut through the noise, the headlines, understand the actual drivers of performance, see what management is really signaling. It just gives you so much more clarity. It's how you really build that deeper understanding.
Absolutely. And maybe a final provocative thought for you, the listener, to mull over. Given the sheer scale of Nebius's planned capital investments, spending billions on hardware, and that aggressive strategy to secure over a gigawatt of power, just how much larger does their market share need to become before that operating leverage we talked about truly translates into consistent, substantial free cash flow from their core business? Something to think about. Okay, before we wrap up, the necessary disclaimers. Financial disclaimer. This report is for informational purposes only and does not constitute financial, investment, legal, or tax advice. The information contained herein is not a recommendation or solicitation to buy, sell, or hold any securities. All investment decisions should be made based on your own research and in consultation with a qualified financial professional. While efforts have been made to ensure the accuracy of the information, no guarantee is provided. And the AI disclaimer. This report was generated by an artificial intelligence model. It integrates data directly from the company's official earnings press release with publicly available market data obtained via real-time web searches. Although the AI is designed to adhere to strict data sourcing and verification protocols, errors or omissions may still occur. All information, including financial data and calculations, should be independently verified by the user before making any decisions. Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.